Hi, everyone. This is Tony D'Amico, founder and managing partner of Fidato Wealth. Thanks for joining me today for this video titled The Market Anomaly We Are Experiencing and Opportunities at Hand. So let's jump in. And actually, before we do, is our disclosure page. The one thing I want to stress is that if you're not a client of Fidato Wealth, we actually, obviously, we don't know you and your circumstances, your goals, and your other financial circumstances. So you shouldn't take what we're providing you as financial advice. You really should do your own due diligence or consult with a financial advisor. All right, so let's go ahead and jump in. So our topics today are the market anomaly we are experiencing, what we're doing to manage our clients' investments, and how we're leveraging opportunities. So first of all, the markets, we are experiencing a bit of an anomaly. It's happened before, but it's rare. It doesn't happen that often. But if you look at this chart here, it shows you the performance of each asset class by year. So if you look at 2022, obviously last year, the only asset class that was up last year was cash and treasury bills. So short-term treasuries and cash on hand. So that was up 1.5%. Everything else was down, including as you kind of scroll down here, if you go down to US bonds, down 15%. S&P was down 18% last year. So the point of this is that typically in a well-diversified portfolio, while some positions are down, others are up. But we could see here in 2022, there was only one asset class that was up. So that is a huge anomaly. And, we know that 97% of the time, stocks and bonds, those prices move in random directions. Here, they're moving in sync, which has made it difficult for investors, right? When both stocks and bonds do not do well, it makes it very challenging. Even year to date, what we see, and our portfolios are very well diversified with 14 different funds that each have a high degree of asset class purity, where they're only investing in that asset class. So there's only about 4 asset classes that are up year to date. And obviously that changes week to week with the volatility in the market. But the same thing is basically happening this year. So again, typically what we see is while some asset classes are down, just as many are up. Again, right now, that is not happening. And I mentioned already how about 97% of the time, stocks and bonds move in random directions. But currently, bonds are continuing to decline in tandem with stocks. And we'll talk about why as well. Quite frankly, the market just stinks right now. I had a great meeting with a client actually yesterday that was kind of the motivation to do this video, because he had some really good questions about why his account was down. And so we talked about we talked about what's going on, and happy to share this with everyone. So let's kind of talk about the silver lining. So bonds are not having a good year, as we mentioned, but we have to keep that long-term perspective in mind. So what's the opportunity at hand? Bond share prices have dropped, but interest paid from bonds is going up. So on a regular intermediate term investment grade bond fund, they're paying 5% or so. It could be higher, could be a little bit lower. That fluctuates again weekly, but the interest rate has gone up. So you're able to reinvest that interest right back into the bond fund. And what you're doing is you're buying back in at much lower share prices. Other opportunities would be if someone has cash on hand to invest. Now is the time to buy bonds. It's not the time to sell bonds. So if you have cash on hand, or through our rebalancing that we do on an ongoing basis, right, we will pick up which asset classes fell the most and sell the ones that are up the most, and continue to rebalance on an ongoing basis. Now, rebalancing is something that makes a large impact, but over a large period of time, right? The benefits are gradual and they continue to build. So the other thing I have on this screen is I wanted to review what the annualized 1-year rate of return as of September 30th, 2023 for the one of our core bond funds that we use. So we use an institutionally managed bond fund, this DFA investment grade institutional share class. And over the past year, it's up 2.97%. Now, if you look at two very commonly owned passive index funds or ETFs, it's the iShares Core Aggregate Bond Fund and the Vanguard Total Bond Market Fund. You can see how, I mean, the outperformance is substantial. So it's, ranging from, 2.3% to even higher, 2.5%, 2.6%. So the bond fund is doing way better than just indexing or just taking that passive approach. So I think that's important to note, and something I want to provide you visibility on. So how does DFA accomplish that? Well, they're not just passively buying the index. They are monitoring bond prices every day. Every day they're looking at the bond prices and looking at how are they trading. They have a proprietary method to identify bonds that trade a certain way where they'll sell them because of how they're trading. There's a good possibility, a good probability that they might go from investment grade to junk status. The problem is that when a credit rating agency makes that change, it's too late. The bond price will change dramatically, and so they stay ahead of that. They're monitoring what bonds are paying, and as far as also they're looking at the term risk, right? So they are optimizing this on a regular daily basis. And the institutional managers that we use as well, they also do this on the stock side, on the stock side of things. But having some management on the bond side has typically paid off over the long run. There's that consistency, and it's continuing to happen now. So I think this is a silver lining to kind of show you behind the scenes. And in general, I think it's important, and our clients expect this, that we're reviewing the funds that we use on an ongoing basis to ensure that they are meeting or exceeding expectations. And I couldn't be any more pleased with how our managers are doing. So, so hopefully that helps a little bit. But let's talk about some other things that we're doing to manage our clients' investments. So the number one thing that I'll share with you is that you guys are counting on us to have relentless discipline. And that's what we have. That's what we do. We stick to the investment philosophy. We stick to our processes, just like our institutional managers stick to their processes. We're doing the same on our end. I think one important thing to note is that, I'll do like an annual benchmarking, and we'll benchmark how we manage investments compared to other financial institutions, other RIAs. And what we typically see is that many might have only 7 to 10 different asset classes in a portfolio. We sometimes even see fewer, and we avoid taking that cookie cutter approach. Diversification is very important, and we believe it's paid off for our clients, not necessarily in portfolio gains, but in limiting losses. So it's, again, we have 14 different funds in the portfolio. Each of them invest in a specific asset class, and they're not correlated. And we'll talk about that in a minute. Again, the focus on evidence-based and an evidence-based approach to investing. So we subscribe to that philosophy where we look at what is the evidence in the market, what's statistically significant, and we and our institutional managers trade on the evidence. We know that the size of a company matters. The price of that stock compared to the value of that company matters. The profitability of that company matters. Those are all things that matter when it comes to stock selection and things that they, again, evaluate on a daily basis. On the bond side of things, it's the obviously the credit quality of the bond. the direct, like the term, right? The longer the term, the more risk. And they're looking at the interest being paid and seeing if that's optimal. And when it's not, again, they're making adjustments. So I kind of just talked about what our institutional managers are doing on an ongoing basis. I've already talked about their performance, and we've talked about also too the bright side of bonds right now. We touched base briefly on having a portfolio of uncorrelated assets. This is critical. Um, and I can think of Ray Dalio. So he ran the largest hedge fund in the world. And I love this quote. He said, "There's no perfect investment. It's about having a portfolio that is diversified and that when some assets are down, others are up or neutral." Okay. Obviously, what we're talking about right now is, yeah, we're in a rough time. That's not quite happening. It's very unusual that everything is down. And we also mentioned the design and the intentionality of our portfolios. So we do ongoing due diligence on a daily, weekly, monthly, quarterly, and annual basis. And again, that annual benchmarking is something that we've done for years and years, and it's really allowed us to really refine our portfolios over the past decade, where we have what we need to execute for our clients and their financial plans. Threshold-based rebalancing. So that's something that we obviously are doing to manage your investments. We're continuing to rebalance on an ongoing basis. Now, we had a bit of an anomaly with COVID. It was a sharp decline. We were anticipating a V-shaped recovery. Thankfully, that's what happened, but we rebalanced very quickly to take advantage of the fact that stocks dropped, bonds went up. So for the most part, we sold bonds to buy the stocks, right? So what are we doing there? We're acquiring more shares at a cheaper price. So we're averaging down the cost per share. And then in the hopes that what we know is that the best days in the market typically occur close to the worst days. Not always, but that's how it's been. And so that's what happened. We had a very quick recovery, and our client portfolios bounced back very quickly, and the rebalancing amplified that. And that's wonderful, right? It's wonderful to get that kind of immediate gratification, but that doesn't exist in investing on a typical basis, right? This is going to be a different test, right? For the past decade, we've had low interest rates, low inflation, and high returns in the market. And so, right, and that's the perfect trifecta for for finance and wealth management. Right now, what we have is high interest rates, high inflation, and low returns. But however, that scenario I described is why our clients have a financial plan. And that's important too. And that's another thing that we do to really manage our clients' investments is we benchmark how we're investing to our client's financial plan. So the person that I was speaking with yesterday, they had a strong financial plan. It had a probability of success greater than 90%. And so in that model, it's important to understand it's assuming some ugly years in the market. And in his scenario, he doesn't need to worry about his portfolio. He doesn't need to check his portfolio if he chooses not to, because his plan is solid, and we're going to continue to monitor that plan. I think it's important to realize while we're in an anomaly, it's very dangerous to think, oh, this time it's going to be different, right? We're all everyone's financial security is based upon the American economy prevailing, which it has, right? So let's talk about performance tracking as well. I think this is really important. And again, I don't blame people for doing this, but this is just a Yahoo Finance chart of these different asset classes. And what I wanted to do is I looked at the past 2 years, okay? And markets were pretty much at their all-time high at the end of 2021, right where my mouse is here. So I've talked to a couple of clients, and listen, I don't blame them, but I think this is helpful information. They're measuring their performance of their funds back to this date, which at this date, like if this was a 10-year chart, that would be the very top. So picking a arbitrary date to start tracking your performance is not a good idea, right? Because you're going to benchmark your performance to here and it's here, right? But the question becomes, is you're here now, but when you first started investing, you were probably down here, right? The question is what is your lifetime return been? And we obviously can't report on the lifetime return for our clients, right? Because we haven't managed their investments for their entire life. We have plenty of clients where we've managed their investments for, well more than a decade. Okay, but so again, this is just a chart to illustrate that concept. This is showing over the past, instead of the past 2 years, what if we looked at the past 5 years, right? You can see the sharp COVID dip. Things have rebounded. Some couple assets are up, almost 50%, 30%, etc. So again, this is part of what we call keeping a long-term perspective, and I'll talk more about that. So do yourself a favor, and you can't pick an arbitrary date or an arbitrary start and end point to track performance. That is futile. I think that's really important. Also, too, I could think of another example where someone said, hey, my portfolio is performing X%, but if I compare it to the S&P 500, it's down. And yeah, that was the case for that period of time, but there is one fund in the portfolio is the S&P 500. But what research shows is that being globally diversified produces a better rate of return with lower risk over the long run. But I don't know what the market's going to do 1 week or 1 year. This is long-term perspective that will give you the greatest probability of success of accomplishing the best rate of return given the level of risk that you're taking. Okay, so a little bit more about how we're managing risks. So one of the things that we talk about with clients is we actually have part of our bond portfolio that invests in short-term debt instruments, right? And that fund is paying out, I think, close to 5.5% now. Okay, and we use that fund to handle a portion of the bond sleeve, but also when a client has, we use that because clients take distributions when they retire. So based upon the client scenario, that could be 5 to 10% of their portfolio. And that reduces the amount in like more typical bond funds, but the cash is there. What we find is clients typically don't spend more than 5% per year. So we have that bucket to go to, if you will. Or the way to think of it is you're an investor in 14 different unique asset classes. And let's view those asset classes as trees. We're going to go to each tree and kind of take the fruit, the ones that have the most fruit, right? Not all trees are going to bloom at the same time. And this is kind of a tree that's always going to have some fruit. It will never be down, right? It may not be up big, but you'll never be selling at a loss, which is important, right? Now, these short-term debt instrument funds, they do maintain the value of $1. They technically could drop in value. Historically, that hasn't happened. So they are very conservative. We talked about threshold-based rebalancing already, and that's important. There's also short-term bonds in your portfolio. I kind of already described how we manage retirement income. So when you head to the distribution phase, we're very selective on what we're selling. We're going to, again, take fruit from the trees that are bearing the most fruit and leave the others alone. Obviously, dollar cost averaging for our clients that are contributing on a monthly basis, we're taking advantage of that. And dollar cost averaging out as well when we rebalance to fund distributions. So you didn't put all of your money in on one day, and you're not going to take it out all on one day. Diversification. So we talked about that. We have 14 different funds. There's no concentrated positions. The asset allocation is very important. That's like how much is large cap, how much is in large cap versus mid cap versus small cap, international, emerging markets, real estate, global bonds, etc. Down to I would say down to a science. We have that really fine tuned to optimize returns while not taking any more risk than is necessary. I already talked about the institutional management that our providers provide, and then that comprehensive plan. We already discussed that. Fall back on your comprehensive plan. If your financial plan was strong before, chances are it could be strong now. And if you have questions on your plan, reach out to us. If your plan needs adjustments, we will let you know. That's very important. But you want to prepare, you have to prepare, right? That you guys have probably heard this saying that the best time to plant a tree is 20 years ago. The second best time is today. And it's the same thing with wealth management. Okay, so that's why we focus on taking those incremental steps with our clients to strengthen their plan. So that way, when a storm comes, they can withstand it. And then opportunistic planning. I think this is really important. Each economy brings about its own unique set of planning opportunities. So for example, we've had low rates for so long. We've helped so many people refinance into lower rates, which change the trajectory of their financial plan, right? So you have to take advantage of whatever the economy is bringing, but also whatever your financial plan brings to you as well. And that's what we'll talk about next. The focus on opportunities, controlling what you can control and sticking to your plan does not equal doing nothing, right? There are actions to take place. So number one is tax planning. So if you do Roth conversions, it's a great time to do Roth conversions when the market's down, because what our clients typically do is we're converting shares. So if you can convert, right, more shares, right, because the share price is down into the Roth, then once it bounces back, it'll bounce back faster, right? So that is huge. And these are things, again, do they make a huge difference after 1 year? No. But stacking these decisions over a decade should change your complete financial trajectory. And that's what our goal is. Investing, again, now is the time to buy. If you have extra cash, I would not buy a CD. I would not put any more money in the bank more than 3 to 6 months of emergency expenses. Our portfolios have that accounted for, and we can rebalance. Keep in mind, 401k limits were raised for 2023. So keep that in mind. If you haven't adjusted your 401k limits, now is the time to do that. That's the other thing. Now is not the time to decrease what you're contributing to your retirement plan at work. Now is the time to double down and increase, right? So one of my favorite Warren Buffett quotes is, be fearful when others are greedy and be greedy when others are fearful. You have to pounce on opportunities like this. And the worst thing, or maybe if let's say for some reason, none of these applied to you, a good decision could be to do nothing, like turn the news off and go enjoy either your life, your family, your retirement, whatever it is that you have. I think that's really important. Sometimes doing nothing is a huge win. If you typically make Roth contributions or IRA contributions, or maybe contributions into a non-qualified account, I would strongly consider taking advantage of these prices. Could it drop more? It may. I wish I had that crystal ball. Do you have assets with a tax loss? If so, consider harvesting that loss. That could reduce your tax liability. And that's something that we monitor as well on our end. Are you planning to retire in the near future? I think it's important, if so, to revisit your plan, ensure you're comfortable. That's another thing too that I want to bring up is one of the conversations I had this week was somebody who just recently retired 2 months ago. They retired 2 months ago and the market stinks. And like that's such a huge adjustment, going from working and earning a paycheck to being retired and turning that into an income stream. That is difficult when the sun is shining, the markets are up, interest rates are up, inflation's low. That's difficult then. But in their scenario, their financial plan is rock solid, a very high probability of success. There's tax planning laid out that will make a significant impact. So again, these are things that we want our clients to reach out to us for, because that's a huge change. And we want to hear from you. We want to hear, hey, I retired 2 months ago. Markets aren't doing well. If that's a concern, right? If you have a concern and you wake up the next day and you still are concerned about it, reach out to us. So very important. Are you planning to make a major purchase? If so, are those funds in cash already? If not, you may want to reconsider the timing of that purchase. Do you have any other planning areas that we've identified to help you that still haven't, that still need your attention? I think everyone knows we follow up if items are not being acted on. We want to help our clients strengthen their plan and add to their bottom line on a yearly basis through all the different planning that we provide. That's our goal. And again, wealth management is all about stacking many optimal decisions. Some of them are small, some of them can be large, but even stacking small optimal decisions over the long term, like a decade plus. Why am I referring to a decade? Because I have that viewpoint of working for clients for a long time. And those that take the right actions year after year, they may not see it or feel it after 2, 3, 4 years, but they do start to feel it. Sometimes it's after 3 years, and see it. After 10 years, boy, oh boy, is there a difference if you've mitigated taxes, minimized risks, rebalanced. Wealth management, there isn't that quick gratification, which is why many people aren't successful at it. All right. So conclusion, I think this might be a longer road ahead of us. This is something I've been saying now for the last couple of years, even going back to last year. So I think discipline is going to be needed, and keeping that opportunistic mindset. One of the things I want to talk about is today, there was a Wall Street Journal article. Actually, it was yesterday on October 5th of 2023, but it's talking about why longer term interest rates have went up this week. And, one of the things that it's talking about is that, again, we had a long period of time of low rates, low inflation, high returns. But now with interest rates going up, it's putting more pressure on the government to fix the deficit because of their borrowing costs. So, we're going to kind of see all of that play out, and the importance, right? And we're not talking about politics. We're talking about the finance piece of our government. We're not talking about which side of the aisle, right? We're talking about the finance piece, but you're going to start seeing this in the news more and more, because when interest rates go up, the government's borrowing costs go up. And when that happens, you need to make good fiscal decisions. So let's also remember that the capital markets are a forward-looking indicator. Markets sometimes will begin to shoot upwards while we're in a recession. And we're technically not in a recession, but we could be in a recession. If we are at some point, the market doesn't just, again, the market is forward looking. It's knowing that profitability is coming and the markets start to move, which is why we can't time the market, right? You guys have seen that slide I've showed you. The costs of timing the market are substantial. And because the best days in the market often occur right after the worst days, it's one of the worst things that someone could do. Keep that long-term perspective in mind. So this was also part of a conversation that I had this week. And they said, well, I'm 65 years old. So how long-term can I look? And so that was a really good question, but we're not talking about that sort of, like, we're not talking about how much longer you're gonna live. That's what we're talking about. We're talking about, like, you can't let the news of this week or this year affect your decisions that will have that could likely produce a negative financial impact, right? You can't get caught up on whatever the situation is at hand. I think it's important to fall back on the evidence. So we talked about that. Taking an evidence-based approach, not only to investment management, but also to wealth management. Turn off the news a bit. I think that's really, really important. I have made a decision to read certain publications and not watch the news. I get my data and they're objective resources, and that's what I found is best for me. And again, take opportunistic actions that are in your best interest. There's always something that you can do. And if for some reason there isn't, a win is to do nothing. All right, so that's the conclusion. I have a couple of supplemental slides that I think that you'll like here before I officially conclude. Markets have always rewarded discipline. This is showing you kind of a world index, the MSCI World Index from 1970 to 2021, and you can see that it's overall gone up. But look at all of the stuff that's happened during that period of time. We have an Arab oil embargo. We have oil prices quadrupling. The S&P 500 dropped 43%. Business Week, a news kind of a magazine publication, came out with a the whole magazine, and at the very front of it, it was called The Death of Equities, and they were predicting that equities were going to underperform for years and years to come. Well, that didn't turn out right. We had Black Monday, we had a savings and loan crisis, we had the when Iraq invaded Kuwait, we had the Russian financial crisis. Remember the Y2K scare? Like everything was going to stop, right? We had 9/11. We had hurricanes, home prices, the subprime mortgage crisis, COVID-19. The markets keep moving. I think that's important to note. They don't always go up. I wish they did. But if you look at all of the doom and gloom, so just remember, good news doesn't sell. And fear and greed are what gets people's attention, whether it's news, media, or things like that. Avoid at all costs anything associated with the frame, this time it will be different. That is one of the most dangerous things that I've heard anyone say. This is showing you the longer you invest, the lower the risk of losing money. So let's look at somebody that has been invested for 10 years. So this is how many times there's a positive rate of return. 95%. Only 5% chance that you will have lost money. Look at 15 years, 99.8%. This is what I'm talking about. You have to invest long term. If you're thinking of investing for a 1-year period or a 5-year period, typically when we have a newer client over the past decade, they get that, they see what I call proof of concept. Yes, my investments are going up. Great. Well, hopefully I've given for our newer clients, especially our newer clients over the past 2 years, right? It's important to note, number one is we have 98% client retention. Number two is that it's the past 2 years is tough. And the longer you invest, you have to keep that long-term in mind. This is something that's going to have to play out over time. Okay, lastly, Dalbar does a study each year, and they look at 30 years of returns. And what this is looking at is what the average person obtains if they're invested in 100% stocks. Their return that they have averaged for the past 30 years is 7.13%. However, the S&P 500 has averaged 10.65%. That is a tremendous difference. Why is that? It's because people, unfortunately, the vast majority of the time, will buy high and sell low, or make the wrong financial decision at the wrong time. And that's really, obviously, that's not ideal. If you look at the difference, right, in the value of between those two results, it's significant, right? So I think this just kind of further indicates the importance of keeping that long-term perspective and being aware of these behavioral finance mistakes that sometimes people can happen. So, all right, great. Well, I hope you found this video to be helpful. We are here for you if you have questions, concerns. We have our eyes on things, and we're happy to help. Again, we're happy to help. If something is, continues to stay on your mind, please reach out to your advisor, and we'll be happy to meet with you. Set up a phone call, Zoom call, in-person meeting, whatever you'd like. So thanks for joining me today. Again, I hope you found this to be of value. Have a great day.